Hey guys, welcome back to my channel. Today I want to talk about one of the biggest beasts that most buyers will encounter when they are buying real estate, and that beast is called credit. Why is it a beast? Simple, because people are intimidated. They don't know enough about it, and they feel like they cannot improve the score because they don't know how it's calculated. So I'm going to tell you exactly what goes into calculating your score so that you don't feel intimidated and you feel empowered to boost your score and buy your house. The first thing that makes up your credit score is your payment history. Did you know that 35% of your credit is calculated based on your payment history? Now that is how many payments that you make on time versus your payment delinquencies or your late payments. The second component of your credit score is going to be your credit capacity. This, by the way, is 30% of your credit score. And what it is the difference between what your credit limit is versus how much money is owed. So for example, if you have a credit card where the limit is $1,000 and you have a balance of $300 on it, that would be 30%. The third aspect of your credit score is calculated by the length of credit. That's going to be 15% of your credit score. And basically, it's just looking at how long you've had a credit line. By the way, if you have had an account, say, for 15 years, right? Maybe a mortgage that you've been paying for 15 years, and then you take on a new loan in this year, 2021, they're going to actually look at the average of your different credit lines in the history. So it's going to reduce every time you take out a new loan, it reduces your credit length. Number 4 in how your credit is calculated is going to be credit inquiries. Now, this is going to be 10% of your total credit score. And basically, it's anytime you are asking to borrow money, whether it's a bank or any kind of other financial institution, or you buy a house. So that's going to be credit inquiries anytime you ask for money. And last but not least, you have the types of credit. Now, the type of credit that you have is going to affect 10% of your total credit score. And what this basically is looking at if you have installment loans versus revolving credit. An installment loan is going to be anything where you borrow a certain amount and then you pay it off the same amount every single month. That would be like a mortgage loan, or if you buy furniture or a new car, something like that. The way your credit is affected with those is that as soon as you borrow the money, you owe 100% of it, right? So if your car is $10,000, you owe $10,000. But as you pay it off, the amount that you owe on it decreases. When you hit zero, that's when your credit is going to skyrocket. Now, revolving credit is a little bit different because that's going to be something like a credit card where you borrow, you buy something and then you use your credit and then you pay it off and then you borrow again, etc., etc. You don't want to borrow ever the full amount because that is going to negatively impact your credit score.